Imagine saving thousands of dollars in tax every single year without buying another property, without raising the rent, and without spending a single dollar. Yes, it is completely legal, and many investors either forget about it or don't understand how powerful it is. It is depreciation on properties. In this video, I will explain what property depreciation actually is and how it works, and two main types of depreciation you can claim and the important differences, and how to get started and avoid common mistakes that could cost you thousands of dollars. Hi, my name is Eric Lee. I'm a chartered accountant with more than 15 years of experience and also a real estate agent providing comprehensive property investment services from planning to acquisition. So, if you want to get useful tax and property investment tips, please hit that subscribe button and stay tuned. I think you already know, but let me start with explaining what the depreciation is, because there may be someone who's new to this concept. In the property investment context, depreciation is basically the ATO acknowledging that things wear out over time. Just like your car loses value the moment you drive it off the lot. A building and everything inside will also lose value over time as they are getting older. And here is the kicker. As a property investor, you can claim this drop in value as a tax deduction. Why is it a big deal? Because the depreciation is non-cash deductions, meaning that you don't need to spend a single dollar extra to get this deduction. It actually allows the investors to be in a negative gearing position for tax purposes while still enjoying positive cash flow in real life. For example, if your rental income is $30,000 and your property-related expenses are $25,000, you are in the cash positive position of $5,000, right? And let's say you can claim $15,000 depreciation for that year, then your tax position is now negative $10,000. So you can reduce your taxable income by $10,000. If you are on 34.5% tax bracket, including Medicare levy, this means before depreciation, you had to pay extra $1,875, but now you reduce your tax bill by $3,750. It is $5,625 difference made by claiming depreciation alone. This kind of scenario was actually possible when the interest rate was 2%, while people were collecting 3 to 5% rent. But nowadays, it is pretty much impossible with today's interests like 6, 7, or even 8%. But what I'm trying to say here is that depreciation plays an important role in property investment. By the way, for those who are not familiar with the negative gearing, I already made a video about it, so you can watch this video until the end, then you'll be able to click the video's thumbnail at the ending scene. Thank you for still watching, and more important information is about to be said. Let's dive into more details. There are two different types of depreciation you can claim. The first one is capital works deductions. We sometimes call it Division 43. This covers the structure of the building, things like bricks, concrete, roofs, doors, etc. If your property was built after 16th of September 1987, you can generally claim 2.5% of the construction cost each year for up to 40 years. So if construction cost was $400,000, you can claim $10,000 tax deductions every single year for up to 40 years. Pretty good, huh? But there is more. The second one is of depreciation on plant and equipment. These are the removable or the mechanical items inside the property, things like oven, carpets, hot water system, blinds, and etc. In the past, all property investors were able to claim this, but after 9th of May 2017, it is no longer to be claimed if you bought a second-hand residential property. However, you can still claim it on brand new items you actually purchased and installed yourself, rather than the ones already there when you purchased the property. You may want to ask, how much can you claim and how can we calculate it? In order to claim depreciation on your investment property, you have to get a tax depreciation schedule done by a professional called quantity surveyor. That's a specialist who inspects your property, works out how much everything is worth, and prepares a report so you can hand it over to your accountant. It usually costs around $500 to $700 for residential property, but it depends on the companies you use. And trust me, as both an accountant and a real estate agent, I've seen this report alone save investors anywhere between $5,000 and up to $20,000 to $30,000 in tax every single year. Yes, it doesn't cost a few $100s, but it is also tax deductible, this fee. And the return is almost always worth it, but not always. If your property is too old, like 25 or even 30, 35 years old, it may not be worth it because there's not much left to claim. If you're not sure, you can actually contact one of the quantity surveyors and ask them, and they will tell you if it's worth it or not. However, even if your property is old, don't assume that you can't claim anything. If the property was renovated, even by previous owners, the renovation still can be depreciated, and a good quality surveyors will dig deep into that for you. Honestly, if depreciation was an online dating profile, it would say low effort, high rewards, and it makes your accountant happy. Sorry, this joke was made up by the ChatGPT. Sorry. And lastly, there's a big and important difference between the depreciation on building and structures and depreciation on plant and equipment. The depreciation on building and the structure, actually it needs to be added back when you calculate your capital gains tax when you sell it. So you might think, oh, that means that deduction is only temporary. Not really, because when you claim the deduction, when you claim depreciation, you can claim 100% of it. But when you actually sell the property, you usually get 50% CGT discount as long as you actually held it for more than 12 months. So your deduction is 100%, but you pay tax on 50% only. So it is still worth it. But depreciation on plant and equipment, you can claim it, it's done and dusted, you don't have to add it back. In conclusion, if you are investing in properties and you are not claiming depreciation, you are literally leaving money on the table. And as someone who understands both sides of the fence, the property and the tax side, I can tell you this is one of the easiest wins you will ever get in your portfolio. This is all, and I hope you got some value out of today's video. If you found this video useful, hit that subscribe button for more property investment tips just like this. And if you need help with your tax or investment strategies, contact me using the contact details in the description below. Thanks for watching, and remember, smart investors don't just buy properties, but they actually maximize every single dollar from them. Thanks for watching, and bye for now.